This is Michelle Smart coming to you with your daily ASMR mortgage rate updates. Let's get into it. Today is a special day where I am using visuals for you. I wanted to show you the Maricopa housing market trends as well as rates because this ties in to the conclusion of these quotes, which you definitely want to stick around to hear. This page I found on Redfin, and it summarizes the Maricopa housing market trends here in Arizona. When we say median sales price, we are saying the average cost for a home sold at a given time. Now, I set this graph to 5 years, and here you can see all the way back in 2019, the median sales price was much lower. That is below the $250,000 sales price line. Here we are 6 years later, and there has been ups and downs along the way, where our median sales price is more than $100,000 more than it was 6 years ago. You can see we peaked here. When was this? We peaked here. And we are skating around and slowly moving our way back up as the markets do. Why is this important? Well, it's important if you're considering buying or if you are also currently owning and considering selling. Let's get into it. There are many different mortgage programs, and some of them are tailored to first-time home buyers. First-time home buyers have incentives where your interest rate for the Home Ready program and other down payment assistance programs does not lower or raise in cost based off of your credit score. This is huge. Also, you're offered a lower rate at a lower cost than you would be if you were not utilizing a first-time homebuyer program. When looking at our lowest down payment program with an example sales price of $500,000 and a down payment of 3%, that is a $15,000 down payment. Today's interest rate, it is January 28th, is 6.375% at a 6.487% APR. That means this rate just cost $78. I am fortunate to work for a company that can guarantee we can beat anyone else's prices for their interest rates here in Arizona. And if we cannot beat their rate and you close with them, we have to pay you $1,000. Terms apply. Contact me if you want to see if I can get you a lower rate. Now, if you're buying a home at $500,000 and utilizing this nearly zero cost interest rate of 6.375, your principal and interest would be $3,026. I estimated taxes and insurance and pulled up a mortgage insurance quote showing for this program at a 760 credit score, your monthly mortgage insurance would be $130 per month, equaling a total monthly payment of $3,555. Now, if you wanted a lower monthly payment and were interested in a house that would cost less, say you're interested in a $400,000 house. Your mortgage insurance is based off a percentage, so that goes down. Your principal and interest is also based off of your interest and your loan amount, so that also goes down. And you would be around $3,000 a month, depending again on property taxes and insurance, with a $400,000 purchase price. Now, in the future, if rates go down, which of course we all hope they will in the next few years, you could refinance. Say you lived in this home for 3 years and the rates finally dropped down to 4%. This is hypothetical. This is not today's rate. Your monthly payment, you'd be able to refinance down to about $2,360 a month. Much more affordable at that lower rate. However, you would be in this house for 3 years while waiting for rates to go down, instead of renting while waiting for rates to go down. What does that mean for your equity position, your net worth, the value you grew in your home? For this home, the value you would have grown in your home, you'd be at almost $90,000 of equity position. Now, when thinking about how much you actually increased in value, that does not include your down payment. That's $89,265 minus your down payment of $15,000. In 3 years, your home would have amassed $74,000 for you from you just living in the home. 5 years, if the market grows at 5% per year. In 5 years, you would have amassed almost $150,000 of an equity position, and in 10, $323,000 of an equity position instead of paying rent. If you're paying $2,000 per month of rent, that's $24,000 per year. Over 10 years, that's $240,000 that goes into someone else's pocket instead of your own. Even though interest rates are high right now, home prices are relatively lower than what they could be, especially with more competition. Now, when comparing a first-time home buyer program to a regular conforming program, this is a less restrictive program, but it does not carry the incentives. You have options. You could put either 5% down. With this particular program that is not a first-time homebuyer program, your 5% down payment of $25,000 would get you the same interest rate of 6.375. However, because this is not a first-time homebuyer program, your cost for that rate is $7,125. That is almost that is a little more than $7,000 more expensive, even when doing a higher down payment. When looking at the 20% down option, the cost for that interest rate is a little lower, $6,500. And these are not first-time homebuyer programs. It is important to get into a home when your income is still relatively low so you can apply and take advantage of these first-time homebuyer programs. They do have income limit restrictions. Lastly, I wanted to compare apples to apples of a regular conventional conforming not first-time homebuyer loan to a first-time homebuyer loan, both at 5% down. Same interest rate of 6.375%. The regular loan is a 6.635% APR in comparison to the lower APR of the first-time homebuyer loan of 6.489. And this APR difference comes from this $7,000 difference of interest rate cost, as well as the slightly lower monthly mortgage insurance rates for first-time homebuyer programs. Also, you can see about a $7,000 difference in cash to close due to the difference of loan program. I hope you all have a wonderful day, and if you would like to see what you're qualified for or are working with another lender and want to see if I can beat their pricing, contact me today. I always have enough time for you. Have a great day.